It's a pleasure to be here, and thank you so much for your kind introduction. I will share my screen so that you can see my slides. Let me do that. What I was hoping to do is to share with you kind of a broad view of how I believe big data, machine learning, AI are changing consumer financial markets, and in particular where there are still, as Rina said, opportunities for research, challenges that we as a profession can contribute to and also have an impact. And let me also say again, if you have comments, questions, please, kind of don't hold back your questions, but kind of ask them as we go along. And I will hopefully be able to manage both the presentation and looking at the chat. So, kind of just to get us started, right, you all have, I'm sure, read and seen a lot about people almost using hyperbole in describing how important these new tools of machine learning AI will be for many dimensions of our life, and of course finance as well. So Sundar Pichai, for example, the CEO of Google, has said AI is going to be more important than humanity's mastery of fire or electricity. I think that's a very kind of steep claim, given that kind of to use AI we will need electricity, but that's all right. But I also wanted to put things a little bit in context, because I've found this quote, which I actually find very nice, right? So the age of quantification is now fully upon us. We are now armed with a bulging arsenal of techniques of quantitative analysis. It is a scientific revolution of the very first magnitude, right? Sounds like AI, but look, this is George Stigler, presidential address of the American Economics Association in 1964, right? So this is basically, I just want to show you, there have been several revolutions, if you want, in how much data and how we use data in economics and in finance. And while I believe machine learning, big data, indeed will have some transformational aspects, it doesn't mean that our regular intuitions, models, theories, and approaches in finance have therefore become obsolete or will be overthrown, right? But I will want to argue that I believe that there will be two main effects of big data and machine learning on how we should think about financial markets. And the effect it can have on consumer financial markets, right? I will focus on the consumer side. So the two big changes, or if you want, additional power that these tools will bring to us is, first, there will be greater personalization and targeting of services on a vast dimension, set of dimensions. So instead, and it's of course already starting, right? Instead of getting generic advertising, which maybe even 10 years ago you would get, right? Now lots of things is targeted exactly to us. This is not just the way it is communicated, but even how products are structured, the type of customization that you can expect from your credit card to your savings accounts to your financial advisors, right? And this will become more and more important over time. So if we believe that, and the reason, right, why this is possible is, of course, because we have more data on people and we can build models that predict people's needs and, people's responses when offered certain type of services and products. But it's also the case, so we have this additional data and we have the computational power to even in time use this information. And so what I will focus a little bit on during the talk today is that power that financial institutions get from big data and machine learning, though, can be used for positive and for negative purposes. What I mean with this is that, right, on the positive side, it means we can now better model credit risk, reduction in adverse selection. We can save people having to wade through a lot of clutter and stuff that they just don't want to engage with, and therefore save people time, etc. But, and all this obviously is very positive. We've seen, if you look at the actual cost of, say, personal credit over the last 10 years even, it has really dropped, even small business credit. And a lot of it has to do with the fact that we now have so much better and powerful transactional data that allow us to model risk better, to model people's behaviors and firm behavior better. Now, on the negative side, though, and I will show you some results on this today too, right, is that with this greater personalization comes also more targeting of people based on maybe their financial literacy or lack of financial literacy, or even, say, situations of distress where people might be particularly vulnerable to either confusing information or predatory behavior. And and that some of that was previously not possible because we couldn't model, in a way, consumer mistakes in the same way we can now model it, because, say, we can look at past behavior and see when, you missed a payment by just a day, but then still paid it, or, kind of other signs of people being, say, inattentive, but able to pay, right? So those are kind of people where, institutions can often extract a lot of rents. Right? So that's what I mean with, the benefits, but also the potential dangers of this greater personalization. Then, kind of the other big change that we have already started seeing in financial markets due to big data machine learning is that it is leading and has already led to massive reduction in transaction costs. Transaction costs to distribute, design, and provide products and services to mass market consumers that previously might never have been part of those services, right? All the way from, think about what's going on right now with Robinhood, where, even kids are apparently now trading fractional shares, right, on a brokerage platform that, even 10 years ago, right, you would have to have been a relatively wealthy person to even have access to this, right? And so, again, right, on the positive, it means that it is actually possible to provide much better financial inclusion, to even provide financial advice, help in decision-making at a scalable and efficient level. And I feel, kind of there's huge opportunity here. But on the negative, it also means, right, that there's now cheap proliferation of services that might be misleading, crowd your inbox, and just generally will make people confused. And so again, right, it will very much depend on how people can use these tools that we start seeing to become so important in consumer finance. Yeah. So I see there's a question, what is your take on bias in the data? ML is only as good as the data that it learns from. That is correct. And if that data is biased, say based on race and gender, right, that's not a good thing. I completely agree with you, right, that we have learned that ML models are only as good as the data and the awareness that we have in how we build the models. I will talk a little bit about this in a second, but just in a short notice, I want to just say one thing, and that's why I believe that how we use those tools and to some extent how smart we also regulate the use of this tool will be very important. Why am I saying this? Because if you think about, right, it's true that algorithms can be, say, racist or sexist if we are not careful, but people can too. And, kind of loan officers, we know, right? There are many that, kind of might be, have implicit biases or explicit biases that they might use when making decisions. And, kind of my hope is that actually in algorithmic lending, for example, once you understand that the data itself was collected in a biased way, you can try to undo the bias, either by, forcing a better collection of data, or by statistically trying to understand, right, like what brings about the bias and how to correct for it. And some of that might actually be kind of more efficiently doable than debiasing people, right? We see how difficult it is to change people's minds. And, and some of it has to do that we all like somewhat, love our own opinions, right? And don't want to move them, but also because we now see that the provision of information itself has become so fractured through all the different information channels that people can choose, that sometimes that in itself, right, is a huge challenge. So therefore, I don't think that per se ML, or algorithmic solutions have to be worse than human solutions. I mean, in the end, those are also human solutions, just, kind of more centralized human solutions, right? But of course, it takes really awareness to undo any, mistakes that there could be. Yeah, and I come back to this a little bit when we talk about, what has been done on the lending side. So, in a way, kind of, this was a great question because, you preempted almost where I was going to go now, right? So basically, what I want to highlight in the talk is that these more powerful tools allow financial service companies to provide better services, but they also create challenges for consumer financial protection and for maybe even, at its max, bank regulation and regulation in general, right? So if firms are able to model, say, consumer behavioral biases or consumer confusion in a powerful way, they might indeed use those models to extract rents from the less sophisticated consumers. And, you might then have a bifurcation in the market where the most prepared and financially sophisticated consumers, actually receive much better services, right? Because all the benefits that I was explaining before, they know how to shop for them, and say financial service companies know that these people will select only things that are there in their interest. And so now, you have the financially literate and the financially more sophisticated receive better and better tailored services, and the maybe financially less sophisticated and more fragile people actually receive more and more tailored offerings that, extract more rents from them, or if you want, kind of use their financial unsophistication in a way that's not helpful to the consumer, right? And so this is why I think in general, where I feel a lot of research opportunities are in this area, is to really understand how can smart regulation or the use of smart tools help us not stifle innovation, not stifle, kind of interesting new proposals, but at the same time protect the people that might not be as prepared to engage with these new tools and these new interfaces. So, kind of in the backdrop, this is in a way the motivation why, I'm myself, at least, am, really interested in these topics, and I feel, kind of they are, something we want to really engage in as a profession. With this backdrop, I want to focus my talk on basically, kind of 3 areas, and I focus on the second 2 maybe a bit more. So, we already started talking about, how loan origination, the use of data is changing loan origination, and, kind of some of the things that have been done there, and in particular, how the targeting of characteristics is either used to, if you want, identify the financially less sophisticated and behaviorally more naive people. And then I want to also show you an example of a study, kind of where those tools can actually be used to help people make better decisions in a very efficient and cost-effective way. Yeah, and then if we have time, I want to show you one dimension of AI that, you know, kind of in finance at least hasn't received as much attention, which is this idea of how do algorithms and humans interact. And here I mean not humans as consumers, but humans as employees within firms. So, you know, kind of what are we starting to see, you know, how are the say financial origination decisions that loan officers are making, or that, you know, kind of other people within the bank or within a financial institution are making, how much are they replaced, augmented, or incentives are changed for people when they are faced with using AI within their workplace. And I'll show you a, you know, study that we did, you know, kind of where we look at a bank that uses that starts using scoring algorithm and algorithmic lending in parallel with human decision making, right? Which I thought, you know, again, this I feel is an area that is vastly underexplored at this point. You know, there's a little bit of this actually, say, in the economics literature. You know, people like Susan Athey have done, you know, kind of very interesting work on this, but in finance, I feel that there's right now much less done. Yeah. So this is kind of where we're going. So let me show you now, you know, kind of some of the work that I feel is inspiring and interesting in this area. So if you think about, you know, kind of machine learning and, you know, and the power of machine learning for, say, loan origination, credit underwriting, but, you know, kind of lots underwriting of many other financial products, right? One thing that AI really allows us to do is to turn what used to be soft information or soft dimension of a borrower, let's say, into hard information. What I mean with this is, right, you all remember probably the old discussion and this really interesting older or, you know, kind of traditional literature on, you know, what is soft information lending versus hard information lending, and how, you know, kind of one might be superior to the other. So, you know, kind of, I'm here, for example, Mitch Peterson has a very nice summary article of, you know, kind of distilling what has been learned from that literature, right? But actually, if you think, you know, AI, machine learning is actually turning this old dichotomy really on its head, because a lot of the social media data and the, you know, kind of the big data, so to speak, on, say, people's connections, people's, you know, kind of social interactions are becoming so powerful, because indeed, the way scoring algorithms are trying to use them, or targeting algorithms are using them, right, is to make soft information hard, right? And what I mean with this really is that, can I, beyond just knowing your credit score and your likelihood of defaulting, can I distill from your social data your willingness to default, in a way some of your, you know, character, you know, dimensions that might predict what type of a borrower you are, right? So we used to think that, you know, only a loan officer looking into a person's, you know, eyes can say whether you're honest or not, or whether, you know, when your business is going to do poorly, you know, kind of whether you will be still making your payments, right? But what, of course, these algorithms are trying to do is to get exactly at this, right? And to get through what is now data that is indeed machine usable and machine learnable. Yeah. So, you know, kind of, and, you know, you know, some of the papers that have thought about, you know, kind of how to more granularly model this kind of soft versus hard information, right? For example, Einaf Jenkins or Fisman and co-authors are very nice papers. Now, you know, kind of on the negative side, and this was asked already before, right, is that these innovations in loan originations that use new data, you know, kind of are now also potentially allowing potential bias to creep in, right? And what we have so far are studies like Fuster et al. Or Morse and co-authors, right, that compare the predictive power of different models, say of mortgage default or credit scoring, right, by using a much bigger array of data and even people's digital footprint to get a sense of, how good are these models, and then, kind of, are they biased and how much bias is there, right? And exactly as the question actually that was asked before, it is actually now possible, right? And in some sense, what I find very heartening actually from these studies is that what's not great is that, yes, it looks there are some dimensions of bias that seems to be present in certain lending models, but we can now detect this in a much more, if you want, efficient or ready-made way, that that actually might also allow regulators to understand these dimensions much better and to monitor financial institutions better. So, with this, I want to show you, an example of a paper of mine that in some sense shows you kind of with data that it becomes much more possible, and in some sense it's that data actually makes it more readily available to monitor what financial institutions are doing and possibly structure either monitoring or regulations around this. Yeah. So this is kind of now going away from pure origination to saying, can we see that financial institutions target different institutions in kind of selective way, given what the data allows them to know about consumers, underlying preferences, but also potentially their behavioral biases, right? So the question here is, do financial institutions target behavioral biases, of borrowers, or, does the data tell us that mainly what they're doing in their targeting is just target preferences that consumers might be expressing, right? So what we will look at here is the credit card market. I'll show you in a second, but in the back of your mind, think of it as what we're trying to differentiate is whether the targeting of credit card products tries to shroud information or, kind of make information and design features more complex, depending on how much consumers are able to actually understand the features of the card. And the alternative null hypothesis here always is, maybe all they're doing is creating more, kind of fine-grained granular products just in order to capture people's underlying preferences and cater to them, right? So the former, of course, is a more behavioral story. The latter would be a completely rational story where people just have different levels, say, of credit constraints or financial needs, and you cater to those, right? So inherently, this is not an easy thing to test. And so let me show you how the data itself and the fact that we now have much more granular data available can help us make some progress on this. So, I just want to say, kind of, this is actually in the marketing literature, a question that has been asked for much longer, right? As you can imagine, right? This is actually quite core to the marketing literature. But of course, us coming from, kind of finance, we have a particular interest in financial markets. So, kind of it's this, in a way, the classical question in marketing for a long time has been whether marketing is a persuasive exercise, meaning, create either distraction or, some form of, kind of competition by the fact that you're just highlighting the good features and distracting people from the bad features, right? Or is marketing engaging in provision of information, and then it would be competition enhancing and improving because people can shop for the things that they really want, right? So you see the information model of marketing really helps market efficiency. The persuasion view or the behavioral view does exactly the opposite, right? Because it would say people cannot look through the products that are being offered and then are shopping for the wrong thing. And if that's the case, right, competition actually leads to the wrong outcome. And so, you know, kind of let me, you know, in fact, you know, one of the early papers and seminal papers that have made, you know, kind of have built a theory to, if you want, corroborate or to build our intuition in this direction is, you know, kind of the paper by Gabex and Lebsen in the QJE, and then there are a number of very nice papers afterwards by De La Vigna and Malmedy, Heithaus and Kozegi, and also Michael Grapp has a paper in the AR that builds basically on this idea that if you have uninformed consumers, or say financially less literate consumers, when you offer them a product that, say, you know, they call it shrouds or hides some of the key information, consumers who are uninformed might not look for features of, say, the credit card that are not highlighted to them. And then they might completely misunderstand the cost of credit that they're shopping for. While an informed consumer or financially sophisticated consumer might not fall for those type of advertising strategies because, say, they understand that at some point you have to pay for the credit you're taking, right? So take the, you know, kind of the feature of the, say, you know, teaser rate advertising or teaser rate credit cards that we see in the US a lot, right? Where you give somebody a 0% APR for half a year or 12 months. And only on the last page and the fine print do you tell people that actually, once the teaser rate is over, you might pay 18%, right? And so the idea here in these models is exactly that if you have sophisticated consumers, you cannot hide that information from them because they understand you have to charge them somewhere and they will look for it. And then if you don't provide the information, they might not even take your product, right? But for the unsophisticated consumer, who doesn't know that, you know, who doesn't fully understand how credit works or how cost of credit works, right? If you just say 0% APR, they might literally think that they don't have to pay for that credit. And then that has two problems. First, it means that they then shopping for cards that, or offers that indeed only highlight the salient feature of the card and hide or, you know, put into the fine print the non-salient features. And it then might make it so that in a competitive market, the honest firms that tell people, well, at some point I have to charge you, and look, then I'm going to charge you 18%, they cannot compete with the firms that actually are, you know, catering to the saliency, right, or catering to the behavioral biases. On top of it, what this literature also points out actually is that it can lead people to take too much credit, because if they truly think that it is a 0% APR, they might think, yeah, then I can afford $5,000 of, you know, kind of credit. If they knew that it's 18%, right, maybe they would have never, you know, kind of levered up that much, right? So this has real cost to the consumer. And just, you know, kind of to tell you again, right, this is the behavioral view of how these type of credit cards might be targeting and structured. The rational, you know, kind of alternative hypothesis here would be that maybe what's happening is that credit cards are just targeting people who are extremely credit constrained differently from the ones who are not credit constrained. And therefore say, you know, a extremely credit constrained customer might be happy to right now take a 0 APR teaser rate and then later on pay a very high interest rate. Right? And so what we need to understand is, you know, is it the rational model, right? People who take those very backloaded credit card offers are rationally doing it and, you know, have already planned for, you know, what it means for their consumption entry payment path? Or is it more, of the behavioral view, where at least a subset of consumers might not be fully aware of what they're getting into? Now, with typical data, and this theory literature has also pointed out, it's usually extremely difficult to differentiate this, right? Because unless you know basically on people's head that you are the behavioral type versus, you are the credit constraint type, right? It's actually very tough to test the difference between a behavioral model and a, credit constraint model. And here I just want to show you an example from, a paper, an ongoing set of papers that I'm doing with a co-author of mine, Hong Ru, and kind of in Singapore, where we're using really fine-grained data on the US credit card market, and in particular the offer structure of US credit cards that allows us to differentiate it. So again, right? What we're trying to test is whether credit card companies use the underlying big data that they have, or the data they have on customers, to either target consumers' behavioral biases, or are they just catering to, rational credit constraints that people have? And what I will hopefully convince you, at least in this part of the talk, is that it looks like there is actually very different targeting going on for the more sophisticated and educated consumers or household versus the less educated and less sophisticated. What we're finding is that less educated consumers receive much more backloaded terms of credit and more shrouded offers. So in some sense, kind of offers that fall more into the behavioral camp, while the educated and sophisticated customers are getting much more straightforward and non-shrouded offers. And then, I'll also show you how this kind of targeting interacts with people's credit risk, right? So, how much of this is targeting, credit constraint or credit risk versus behavioral features. So, how can, why can we do this? Actually, what's really nice here is that we have data from a company called Compromedia that has been collecting data on US credit card offers for actually the last 20 years, almost 20, more than 20 years. And what they do is that, say for every, not every US customer, but for a representative set of US households across the entire US, they collect the financial mailers and the financial mail that people receive. And so we have information on, a rolling sample of 160,000 individual credit card mailers that are being sent to consumers. The actual mail, now it's obviously a PDF of the actual mail, right? But we also know, and that's kind of what makes this data really cool, is that we can match the data, the mail, the offer structure of the mail with the characteristics of the household. So what we can see, kind of whether, say, a single mother living in Boston, let's say, in such and such neighborhood with this income, this education level, receives very different mail than, say, a married father of two, kind of with a very different education level, different income level, etc. Right? So we are spanning the characteristics of US households. And we seeing, what type of offers financial institutions are sending them. And I'll show you also, kind of basically how this looks in steady state, and then how the Credit Card Act of 2011 changed some of these things, which I think is really neat to see how regulation that is trying to actually engage with this changing industry forces the industry to adjust, and I can show you, kind of how strategies change, kind of over time. Now, what is neat about this data is, kind of, and you see, I was saying this before, that we ourselves can now turn a lot of what normally would have been soft information or, kind of unusable information about an offer letter into real data. Why? Because we have these, hundreds of thousands of PDFs of offers. But what we did is we built algorithms with optical character recognition software and then our own algorithms to extract not just the hard features of the card, meaning, fees, interest rates, reward programs, all that, but also, the softer features of the offer. So the color used in the letter, the font, the type of photos, where the information is displayed, whether a certain feature of the card offer is on the first page in big, bold font versus the last page in, kind of tiny script, right? And just to give you like a visual sense of this, right? This is what I mean. A typical offer letter, right, will look like, all the enticing features, say, the 0 APR for 12 months, big and bold on the front page, maybe with, this nice photo of, kind of going on a trip, which I realize actually, in our current time is not so enticing anymore. But, kind of, you see what I mean? And then, kind of the more unpleasant part of taking credit, right, which is what is the interest rate you need to pay back and so on, is in very small font and often even hidden on the last page and so on. Yeah. And so to show you, right, quickly what we find is indeed that we find information or confirmation that credit card offerers, financial institutions, are using the design features of the card in a very targeted way to differentiate educated from uneducated customers. And they actually are offering less educated customers cards that on the one hand, right, have much higher late fees, higher over limit fees, but say rely much less on upfront annual fees, right? So all the things that basically kind of allow you to push payments out to the future and potentially hide them or not deal with them until they can come due in some months or maybe even, at a later time, right? But you see, kind of, if that was the only information we had, a critical mind would obviously immediately say, well, maybe this is shrouding information to, kind of less educated consumers, right? And not shrouding it to the educated consumers. But maybe all you're capturing is that, kind of less educated consumers need more credit and therefore, or need more aggressive terms of credit, and therefore maybe are happy to take as a trade-off very high late fees or high over limit fees in order to get, say, the 0 APR introductory teaser rate, right? And so here, however, the fact that we have information on how the offer letter is structured helps us actually differentiate it. And so why or how? So what we can do, right? So this is just to show you, this was just the regressions, that I showed you in graphs before. But what we can do, for example, is we can see where information is placed on the offer letter and what language is being used to describe certain terms. And what we find here is that, say, so we use, typical software from linguistics that allows you to classify the complexity of, kind of of language, and whether so this is the FOG index, which, kind of is widely used in linguistics. But think about the second one is just, kind of at what level of grade do you read, right? I don't know, 12th grades, kind of 11s, 13s, what have you, right? And this is a way, again, to in a way classify people by the education level. And what's really interesting that you see, right, is that, kind of basically, kind of if you look at people from the least educated to the most educated, you typically see, right, that the language on the front page for more educated people is actually simpler and more straightforward than for less educated people. And the other way around, for the information on the back page. And, you know, kind of, as many of you obviously have seen, right, the back page, the last page of a credit card offer letter in the US is typically where all the information is, because that's where the Schumer box is. And this is where you have to disclose, you know, what your fees are, what your, you know, kind of all the dimensions of the credit card are, right? And so, and this is just, you know, kind of the ratio of front versus back. But what this is telling you, right, is that the way the card industry is using language is actually the opposite what you would have intuitively thought, right? You would have intuitively thought that less educated people, if you want to convey information to them efficiently, you should tailor the language to the language at which somebody reads, right? But what this is actually saying is that the front page, front page of the offer letter, right, is relatively speaking less likely to be complex for, you know, kind of say, for an uneducated person, but the back page where all the information is that you need is kind of more complicated for somebody who is uneducated than educated, right? So this really looks not like I'm giving a rational person the information they need to shop for the terms that they need, but it seems much more like a, you know, kind of a shrouding device, or a way to actually make it more difficult for people to understand the offers that they get. And then similarly, you know, kind of you know, kind of that's true, you know, kind of also for where different parts of the information is placed. So we're finding that, you know, kind of similar to the effect on the language, we also find that for more uneducated people, more of the important information is just on the back page and never highlighted on the front page of the letter. And again, that's not the case for educated people. And it's, again, you know, the intuition is kind of the Sager-Bex-Lebsen intuition that educated people will know what to ask for or what to look for. And so you shouldn't hide the information from them, because you cannot fool them, because, you know, they might then not even take your credit card because they feel you're not giving me all the information, right? I see a question by Banu in the chat that, you know, kind of has CFPB gone after these credit card companies, right? So the interesting thing is, of course, you know, this is, you know, this is statistical evidence, which, you know, kind of, I think in legal terms doesn't qualify as, you know, kind of an indictment, because, you know, kind of for a legal lawsuit, as far as I understand, right, you need actually emails that say, let's do this to, you know, do harm by people, which, you know, kind of probably they don't do this way, right? I will show you though, what the CFPB has done, and as part of the Dodd-Frank Act, is to reduce the kind of how high the fees are that you can charge in general. And in fact, I will show you in like, I promise, in like 5 minutes, you know, kind of how this has changed the structure of these cards. Yeah. So in a way, it's a somewhat blunter tool, but it's aimed exactly at preventing a situation where, say, you know, kind of as I'm showing here, for example, right, an educated person, an uneducated person, right, receives much higher late fee than an educated person, right? Or look at, you know, same thing for over limit fees, right? While, you know, kind of say on the intro, I mean, the likelihood of receiving an offer with an introductory 0 APR is much higher for an uneducated person than an educated person. Yeah. So on net, right, this part of the results basically seem to suggest that there is a lot of tailoring going on by people's education levels. And, you know, kind of, you can look at the paper, but, you know, kind of, you're controlling for everything else, including income levels, where you live, and so on, you know, kind of to isolate, you know, the educational component. I want to quickly show you, before I come to Banu's point, you know, about the CF, you know, kind of where the regulation has gone. we found it, we were really interested once we saw this amount of targeting, right, and the potential that this was, behaviorally motivated targeting. We thought, can we figure out, how companies trade off the behavioral targeting with concerns about credit risk. And the underlying idea, that we had in mind is that if you think about, say you have a consumer who doesn't fully understand the cost of credit and might think that they literally have zero APR and doesn't understand that at some point the zero APR will, kind of stop, and then they have to pay. Or, kind of as in the Malmendier de la Villa paper, they are just myopic and they understand that, kind of at some point the credit will be, 18%, but they think by then I will have paid back, no problem. And of course, then they don't have the self-control to pay back by that time. And then they're still stuck, with a higher cost of credit. Oh, good question, actually, which I should have. Thank you, Bhavik. So there's a question, which is, which credit card company is driving your results? So I don't know if you think this is good news or bad news. Actually, none. So they're all to some extent engaged in this. So the effects I just showed you even hold, including bank fixed effects. So this is saying within a given bank, right? Say with, I don't pick a name because, whether from, kind of Bank of America to all the way to, whoever else you want, kind of they all seem to display this. So it's not a particular bank that is driving it. In fact, it seems that on average, the industry has figured out that this is a way to target customers. I want to also say, kind of what is, kind of so complicated in this world, as the Gerbeck-Slikson paper also shows, is that an individual, once this is the equilibrium, an individual bank cannot break that equilibrium. Because, right, remember, if everybody kind of tells the unsophisticated consumer, look, zero APR, if you're the one bank who says, wait, let's be honest, everybody has to charge you at some point, so I'm showing you my fees, right? The consumer who doesn't understand it says, wait, this bank says zero, you say some complicated nonsense, I don't like you, right? So when the consumer doesn't know to shop for the right dimensions, it's actually really difficult for the equilibrium, right, to change endogenously, yeah? And Rina is saying all of this suggests that financial literacy is critical, right? So, kind of, I completely agree with this. And I'll show you a little bit of result now, kind of in a second, kind of what has happened actually in response to the Card Act of 2011. But before that, just one quick thing I wanted to show is that we even find that, kind of banks understand that when I target financially unsophisticated or, confused customers with these very backloaded and shrouded features, I might potentially attract a lot of people who ultimately have a risk to default on me. And that's not great for a bank, right? Even though maybe in the short run you extract rents for them, but maybe in the long run, they are a problem for me because they don't pay back. And so what we were looking for is a shock to credit risk that, either makes people in general, or certain parts of the population, right, more or less credit worthy. And what we used is this very nice instrument from a paper by Shu, Matza, and Melzer, that, in 2014, that looked at the mortgage market and actually used changes in the state level unemployment insurance to look at, how people who, in a way, people who get more generous unemployment insurance, in their case, they looked at, are they more or less likely to default on their mortgage? And they actually found that, when unemployment insurance becomes more generous, at a state level, people in that state are less likely to default or fall late on their mortgage payments relative to people in an area where UI has not been set up yet, right? And you see this is kind of allows their paper, and then obviously us too, to set up a difference in difference estimator where we can look at, say, in our case, we don't look at default, right? We look at how firms target customers when, say, within a given state, UI is being set up. And the reason why I say set up is because actually over the last 20 years, no state has reduced unemployment insurance rates, right? It has only gone up. And what we're using are big changes in AI, so above 10%. And so the idea here exactly is to say, when in a state unemployment insurance becomes more generous, it should mean that even, say, kind of less wealthy people become actually better credit risk, because even when they have a negative shock through unemployment, they still have some income, right, and can keep on paying. And therefore, we're exploiting that idea in a diff and diff to see, does the bank then feel, oh, it makes it actually more profitable for me to shroud these customers more, because now I don't have to be afraid that if they didn't understand the terms of credit, right, that they will then default on me, right? If you want a more current example of this, actually, I'm sure you might have read about this, right? The Wall Street Journal was just writing about this. We actually see right now that credit scores and default are going up, and default rates on credit cards were going down for poorer people in the US because, in this case, not UI, right? But with CARES Act checks and so on, for some time during the pandemic, we insulated a part of the population from, the shocks that they would otherwise have had, right? And it basically shows you that this had actually massively positive effect for the credit market. Now, there are other, I'm not commenting on anything else, right? But it's exactly this logic that unemployment insurance creates some buffer for the most fragile people, and therefore their credit risk goes up. And what we're going to look at, right, or what we looked at, is how does this affect the targeting that banks engage in? And interestingly, actually, we find that, you see, in response to UI going up, we see actually more reliance on these backloaded features, meaning more use of introductory APR and more use of late fees and over limit fees and, kind of these other things. And then even kind of more, in a way, shrouding, because we again see more use of pushing things that are unpleasant to the last page, and only highlighting the, say, the zero APR and the more pleasant parts of the card on the front page, right? So this is just to say that it seems that, kind of the industry is using these behavioral models of humans and of different people to target who receives what offer, kind of, and with it, of course, what type of experience people have in the consumer financial markets. So, given the questions that, kind of were already asked, kind of by Bavik and before, right? You could say, why does regulators not do anything about this, right? And here is an example where indeed regulators, did something about it. What did they do about it? Here, what they did in the Credit Card Act of 2011, passed in 2009, and then phased in over the next 2 years. What basically we have is the attempt to eliminate fee harvesters. They call it fee harvester cards. So basically cards that rely extensively on late fees and over limit fees. And in particular, what they did is, kind of, they restricted completely. So you cannot charge over limit fees anymore unless consumers opt into them, which they typically don't do. And then late fees were capped to $25 with some contingencies. Yeah. But and that was exactly to try and limit, kind of banks' reliance on these kind of backloaded and maybe more confusing card features. One thing, though, that, you can call it, I don't want to call it a loophole, but, kind of that is a dimension that was not regulated, is that while, you know, kind of the regulation really limits what you can charge people when you offer them something, it is true that when you have one late fee, meaning one time when you fall late on your credit card, the card company is allowed to reset all your fees immediately. So even before the end of the introductory APR period, right, I can now set your card to the regular APR. So, you know, imagine you have 12 months zero APR, but in month 3, you fall late, and you even only fall late by $10, right? I'm making this very egregious now, but, you know, the card company is allowed, your financial service company is allowed to then basically stop the intro APR and instead, you know, kind of put you on the regular APR. Now, of course, this is well-intentioned because, you know, it's saying when the firm learns that somebody is really a bad credit risk, right, we should allow credit card or financial institutions to use that information to, you know, kind of to reduce their exposure or their risk from a high credit risk person. But it also means, of course, right, in the world of where some people are behaviorally challenged, like, you know, inattentive, confused, you know, kind of myopic, it also means that if you can get people to, in some sense, not realize that this is happening, right, you now can, you know, as an offerer, you can use a different backloading strategy, right? While you cannot use anymore these really high late fees and over limit fees, what you might try to do is get people to take your card with the zero APR, not realizing that if they're once late now, they will default to a much higher APR. And so what should your shrouding strategy then be, right? If you really think, you know, that's what we're trying, what service companies are trying to do to less educated people, is that you want to offer, you know, you would want to kind of explicitly offer a lot of, you know, zero APR cards, but then set the APR that the card will default to ultimately very high. And you want to also change your shrouding strategy by actually now not highlighting the regular APR on the front page, because you don't want people to become aware of the fact that this one is high now and put it in the back, right? And again, as before, right, you know, kind of, I want to see that this is differentially offered for the more educated versus less educated people. And so, right, given that the Card Act is a nationwide, you know, kind of change in regulation, I can't do a diff and diff the way I did before, because it wasn't phased in, unfortunately, state by state. So, I mean, unfortunately for econometric purposes, right? So the way, you know, kind of we're now using this, and this is, you know, kind of a follow-on project with Hongwu as well. We're actually looking at specific credit cards within a bank that were affected by the regulation of the Card Act, meaning that had really high late fees, high over limit fees, and therefore in a way were ex ante in violation of the Act, and compare it within a bank to cards that were already not in violation, right? So basically cards that were already within the limit and therefore didn't need to change anything if they didn't want, right? And then look at the ones that actually were affected. And, you know, we can see, you know, how over the exposure or the phasing in of the Card Act, this changed. And what we find, right, you know, kind of, so you should think rate mean is, sorry, poorly labeled, but this is the APR. What you find is exactly that when the Card Act starts binding, APRs are going up, late fees and over limit fees drop dramatically. That's, you know, that's mechanical, right? Because they had to drop them. Otherwise, the banks would have been in violation of, you know, kind of the Card Act regulation. And obviously the regulator would not have been happy with that, right? So this is kind of almost mechanically just showing that the banks abided by the regulation, not too surprising, maybe. But the interesting feature is that, as I was saying before, you see now this massive increase, right, in the use of introductory APR. and at the same time, an increase in the APR. And remember, this was actually even controlling for, kind of Fed fund rates and so on. This was in a time period when actually interest rates were really very low. Right? Remember 2011 and after, right? And then again, what is actually, very interesting here is that when we look at where on the page this information is now displayed, you see that, kind of the introductory APR is in particularly displayed, of course, on the front page in very big size, so to speak, kind of big font and so on, and bold, kind of why this is the introductory, why the real APR is now actually kind of pushed to the back of the offer letter, which before that wasn't as often the case, and is kind of much less likely to be highlighted, lighted, and in bold, right? So it's basically to show you, or kind of that, number one, it seems with the onset of machine learning and more data becoming available, financial service firms are able to target consumers very differently, not just based on their credit risk. Obviously, that's going on too, but kind of that we are not so surprised about, right? But more and more they are able to actually target people by their education level. Kind of nowadays, right, you see many firms actually targeting based, kind of, and that's often, kind of even for fintech lender, based on your past usage of products, right? So it's even more granular because, say, within the group of educated people, there might be also absent-minded versus non-absent-minded, right? And same thing, kind of at every level. And so now you can cross, kind of, and do this type of behavioral targeting, even in a more directed way. And then the other thing I wanted to show you, with the Card Act, kind of regulation, is that while the Card Act indeed shut down some of the most egregious late fees, we, in the data before, we had some people, late fees of $89, even if you were just falling late by, like, say, $5, on a kind of limit of $500, right? I mean, this is crazy interest rates if you were trying to calculate this, right? So this has been ruled out, but we do see that, kind of industry is creative and then finds different ways of, of bringing back some of this targeting through, say, the zero APR and the shift in where the salience lies. Yeah, so, kind of this is where, kind of what I wanted to highlight in a way of kind of some of the, kind of benefits that the literature has pointed out from better underwriting models, using more data, using, kind of better data, but also some of the potential pitfalls, kind of that we might experience with big data. Let me, kind of, given that I know we all get, Zoom fatigue and so on, let me kind of maybe stop for kind of a couple of minutes and see if there are questions or comments. And otherwise, I'm happy in the last half an hour to show you kind of a more kind of results from a study that maybe is more positive, where we actually did an experiment with a community savings bank to target, kind of lower income customers, to give them better information about, kind of their financial lives and help them, kind of manage their financial lives better. But, kind of, I feel, kind of, I want to give you all like a minute or two to, kind of either drop off if you want, kind of, or ask questions.
Antoinette, maybe I'll ask a question. Everyone who's attending, they're kind of thinking about what are the big issues to do research on in this area. And so I wonder if you can touch a little bit about where do you see this stream of research going? What are kind of interesting data sets that people are using? just any comments?
Yeah, very good question. Thank you, Rina. So on the, I would say, you know, kind of where this literature is going, I think there is a number of dimensions. So some of the dimensions are about how can we model human behavior better with data, right? So for example, so the data sets that you see are starting to come online, you know, like data from Facebook on social contacts, from lots of fintech vendors that people have used, right? I mean, Facebook sometimes it's a very big firm. Working with them might be difficult. You know, you have to really, you know, kind of be able to work with them, and that might take connections or whatever. But, you know, there are many fintech lenders, many fintech organizations now that are doing similar models, or actually quite innovative models, and they might be very, I mean, I don't know, very happy, but they might be happy to share data with researchers, right? And so even one doesn't necessarily need the universe of US, you know, kind of customers in order to say interesting things about human behavior, right? So, you know, kind of there are papers written, say, even, I mean, with data sets like Mint, you know, kind of where you can see how customers who are more careful in how they manage their financial lives have very different outcomes from those who don't. So I think, you know, there is a lot of interest in, you know, kind of in this dimension. I think there's also more and more starting to be an appreciation that, you know, kind of beyond the micro effects, there might be actually a lot of macro effects, right? So it shifts how competition between large and small banks works, how, you know, kind of entry of new lenders, you know, kind of might affect, you know, certain subpopulations, but also, you know, kind of, you know, established players in certain areas. And I also think, you know, kind of we might start seeing actually even more macro effects. So think about, you know, even what I was showing you about the fact that we can now target different parts of the population with either more backloaded or front-loaded offer structures. Actually, that might ultimately have impact on monetary policy, because the pass-through of monetary policy is very different whether, you know, kind of it affects immediately your interest rate or your APR, right? Or it only affects it in 6 months when your introductory zero APR runs out. And so, you know, kind of different parts of the population might experience and either benefit or be hurt by monetary policy very differently. And on the other hand, financial institutions then have to hedge against those type of risks in a different way. And one other thing, let me say, actually, you brought it already up, but I think it's a really important point, Rina. You know, kind of, again, it also means that understanding what drives financial literacy or what are impediments to financial literacy are kind of a really important point, right? So say Olivia Mitchell and Anna Maria Luzardi have been doing a lot of work on not just documenting, you know, how the distribution of financial literacy in the population looks like, but you know, who in a way is then also more affected by it, what type of mistakes people make, you know, how big those mistakes are. So I think this is, you know, a very important area to think about, because very often, right, the financial service industry will always be at an advantage to even a somewhat educated consumer, right? So figuring out how to provide information that people can act upon, you know, kind of becomes actually a really interesting endeavor.
Thank you. And there's another question in Q&A.
Are payday institutions taking advantage of AI? So very good question. So what I know, so I don't know exactly, you know, the payday lender at the corner, you know, kind of where you physically go to. I don't know that industry as well. What I do know is, so there are, it's a kind of adjacent literature to payday lenders. So they called often small ticket lenders. So these often actually are firms that might even partner with an employer, so that, you know, you can get an advance on your page, or a worker can get an advance on the paycheck. And the idea actually originally often was that, oh, you know, it's a substitute for payday lenders, so that, you know, kind of say lower income workers who otherwise might go to a payday lender, rather, you know, kind of get an advance against next month's paycheck. First of all, they don't need to go to the shady payday lender. And the idea actually was that it should actually be doable on a relatively low interest rate, because if you stay employed, right, even the employer can help just repay, or through the employer you can do the repayment, right? And so some companies actually, you know, signed up, or many companies signed up for this. And then there was some concern actually in the industry that the employers were not monitoring some of this well enough, and the interest rates in some of the small ticket lending was very high. And those guys, because everything is digital and you know, kind of online, they were using AI, right? Whom to offer things to, whom in a way to entice to buy, I mean, you know, to take a bit of credit against next month's paycheck. And then suddenly, you know, you might have taken credit against 3 future paychecks, hardly realizing, you know, kind of how fluent this. So what they realized, and then the CFPB did actually some regulatory, you know, at least monitoring of this industry, because what they realized is that for some people, it became even confusing to understand what is the advance against next month's paycheck and what is still the paycheck, right? It was so convenient to take loans, and it was not highlighted enough that you are now spending your paycheck 3 months from now, plus some serious interest rate, right? And so it made it actually easier for these, you know, myopic or behaviorally, you know, kind of more, you know, kind of tempted people, you know, to overly take credit, right? Actually, Justine Hastings at Brown has some papers on that industry that are very nice. Yeah. Great. So, you know, kind of, let me be, you know, kind of, you all should feel free to drop off if you are tired and you had enough Zoom talk. I don't take it personal at all. I've been the subject of Zoom talks a lot too, so I know how this feels. I just didn't want to finish with, you know, kind of just such a dismal, you know, kind of record on where AI is going. So I just want to show you one more positive result on how, you know, kind of machine learning and big data tools can actually be helped or used to help people in you know, in how they make financial decisions. And so this is, you know, kind of a study I did with Ideas 42, which is a nonprofit, as Rina said, that, you know, I co-founded with, you know, kind of 2 people at Princeton and University of Chicago, that uses behavioral economics and psychology to solve social problems. And one of the big social problems is financial inclusion and financial decision making. And this is kind of an example of, you know, basically a tool that we built with a financial service, a community savings bank, to give people information and help them in a way take control of their financial lives in a very efficient way, because we have so much data on people that we can do this in a relatively light touch and scalable way. And so we call it the financial health check, but think of it basically as a way of doing some financial advice in a kind of low cost, but still relatively personalized way to help people, you know, kind of avoid paying a lot of late fees, you know, bouncing checks, you know, kind of basically having, you know, very high cost mistakes in their financial lives. So let me show you what I mean with this is the following, right? If you look at many this is, basically data examples, obviously, from the community savings bank that we worked with. So these are, kind of example payment stream from a low income household, because I wanted to show you often how complex the cash flow streams on a month-to-month basis are that these households face, right? As academics, you often feel like, oh, I have a paycheck, right? I mean, in a way, we are in the nicest situation. You know exactly what you get next month because that's what you got last month. We have planning certainty, right? It's, kind of a very privileged situation. And then, kind of think about, so this household, for example, right? So you have basically a couple that receives some food stamps at time. The husband has a freelance job, but he sometimes does, he also has a construction shop. You see, it's the dark bar. And then the wife, right, does some additional income or generates some additional income when she can, right? And so you see, you have massive spikes in people's income over the year, and a lot of it, which is not even reflected here, with very little planning certainty, because you don't know whether the child, some of the childcare income is last minute, and you don't even know at the beginning of the year that you will have it or not have it, and so on, right? And so in that world, planning for how much you can spend, how you smooth income, kind of over this even yearly cycle is much more complicated, right? For people who face this type of income stream. And what we see in the data, and what this community savings bank has been concerned about for a long time, is that because people have little visibility in their future income and face a lot of shocks, right? They are often they are subject, because of these shocks, to a lot of fees and financial fees that with better planning, they could have avoided, right? So the idea here is not, oh, let's make sure people just get better income or more stable income. How can the financial service company cannot affect this, right? And this is obviously much tougher to affect. But what they see even in the data, and then we see obviously in the data, is that, especially say people that have face this kind of payment variation, often actually have a lot of incur a lot of financial fees through bounced checks. They pay their rent late, they have their say their electricity cut off because they think they're in a high say income situation, they overspent a little bit, and then the next month, right, they have a big dip, or here they have a big dip, and suddenly they don't have even enough money to pay the rent, or they have to decide between rent and electricity. Then the electricity gets shut, right? Then you pay another $100 to get it reinstated, right? So these are all fees that for, kind of a low income household can actually end up costing proportionately huge amount of money. And actually this financial service company was very concerned about how to help people get on top of it. And so what we did with them is, and what we also realized is that because people have so many things going on in their life, right? Just see how many things they have to actually manage on a, kind of month-to-month basis in terms of all the different jobs, right? That without any way of automating some of these decisions more, and to some extent also understanding some of those complexities, you can, if you could help them solve this, you could save people a lot of money in foregone late fees and, penalty fees if they could get on top of it. And so what we did is we basically built an application where, kind of an online application that takes all the data of people's past behavior, meaning how often do they fall late, what triggers their late fees, and because we can see, right, are they paying penalty fees from this bank, from other banks, are they paying penalty fees to their landlords, etc., right? So we can feed this all into basically data, and then we asked people, or we not asked, but we offered them to have a confidential one-on-one conversation for 30 minutes to up to 60 minutes with kind of somebody in the bank to walk them through the, in a way, mistakes that they are making, and then set up automated functions in real time while they are, you know, on this phone call, to kind of, in some sense, automate some of the biggest things so that they don't happen anymore. So what I mean with this is that, you know, imagine if you see that somebody often incurs late fees because they pay their credit card a couple of days late, or because they are $10 late, oh sorry, they have $10 too little to pay all their rent or to pay all their you know, kind of electricity, and that can then lead for their rent check to bounce, right? This kind of, obviously, you know, it's such a tiny amount, but it can then lead to lots of triggered follow-on fees. So how could you solve some of this if it's driven by, say, inattention or people not planning enough? What we did is we built in people's accounts basically the option to say, always withhold enough money when the paycheck comes in, that the amount for your rent is basically cannot be spent by mistake, so to speak, when you go to the mall and you just, you know, overspent a little bit, or you buy something for your kid and you didn't think about the fact that, oh, the rent hasn't gone out yet, and then that might kind of trigger it, right? And so we basically we explained to people that, look, this is how you often run into trouble. And then we kind of allowed them to opt into these kind of automatic solutions. And so just to give you a sense, right? So what happened here is, you know, kind of, we had this over the phone with the person looking at this app on the, you know, kind of web, and the you know, kind of loan, the bank, you know, kind of manager doing the same thing. And then people could make concrete goals for what they want to achieve, maybe what they want to save for, and then opt into, you know, kind of these kind of automatic solutions. Also, the other thing you should realize, right, is that often people actually have very high level credit card debt and save at, say, 3% or even less, right? And even just explaining to people that netting out those two things, right, can actually save them a ton of money. And here you see, it's often people are well-meaning. They think, but I'm saving, right? Isn't that the right thing that I should do? And you, in a way, have to explain to them, actually, you would be saving more if you already paid down your credit card debt, right? So those are the kind of things that, you know, kind of we can do. And, you know, kind of this is exactly, right, how this app would look like, just to give you a sense, right? And then, you know, people can basically opt into all these things. And, you know, kind of, why is this, you can, you know, so what is the power of big data here is that we can pre-populate for the person, and in our case, even, you know, kind of the bank manager, the person's basically symptoms and diagnosis, so that the bank doesn't have to spend a lot of time to, for each person, go through and figure out what is it that you get wrong, right? What is it that this person is actually in trouble with, and why do they get in trouble, right? Which would normally be extremely expensive, because right, or the bank manager's time is extremely expensive, and you couldn't actually afford it as a bank to spend so much money on every individual customer if they had to come into the bank, sit down for like an hour or more and explain what their problem is, the bank manager going through it by hand, right? You see all this kind of stuff, right? So here it's the transaction cost saving part of, you know, big data and AI that really helps us in this, right? And so then, you know, what we did is to see whether this really has an impact. We ran an experiment with the bank where we phased the service in for customers, because, you know, initially they didn't have so many bank managers who could, you know, spend the time doing this. So anyway, they had to phase it in. So it was nice to randomize and then to evaluate, you know, whether this actually makes a difference and has an impact or not. And so what we did, right, we did about 40,000 sessions. But originally in the experiment I'll show you, it's, you know, kind of 1,200 sessions that were randomized into treatment and control group, meaning people who get this type of service versus not. The average call on average, so yeah, was 38 minutes. And, you know, kind of the sessions, you know, kind of were delivered by loan officers or, you know, kind of loan team members from the bank. And we had, you know, between 3 and 4 people, you know, at a given point in time from the bank who were working on this pilot. And so what you see, right, is that they call it members, think of it as clients, right, because it's a community savings bank. So community savings bank members, you know, kind of the majority of them wanted to save more, pay down debt, and then, you know, half of them wanted to save for the long term and stick to their budget. And what we find in terms of impact, right, is that indeed, actually, this, if you want, relatively simple intervention that doesn't necessarily, you know, kind of teach people a ton of finance, right? It just gives them some actionable things to manage their personal finances a little bit better, actually had quite a significant effect. So it had a statistically significant effect, but what we actually find is that on net, the people that were, you know, kind of randomized into the financial health check, you know, after a year had a net new deposit balance of 1,100, I mean, basically 34% more savings than the people in the control group, right? So because this is an RCT, I don't even need to show you really the regressions here because everything is randomized, right? But when we compare, you know, the outcomes after 12 months, we find, you know, kind of that the, you know, kind of on net, right, we actually achieved a 34% higher, you know, kind of savings or cash in the account for these customers, sorry, that were part of the randomizations. We also found, you know, kind of a slight increase in their credit score. And then, you know, beyond that, we didn't, you know, kind of, you know, so far, right, didn't find much else. But you see, you know, kind of what's interesting here is really that to again highlight that the power of big data and AI allows people to have access to kind of solutions that, you know, otherwise might be very difficult for themselves to set up for themselves, or if they had to really meet with the, you know, bank manager who has to customize all this for an individual person, it would be way more too expensive, right? And so right now what we're doing with IDS 42 is to scale this with more banks and, you know, kind of larger set of customers where we also built in more customization for, you know, kind of different needs that people have. So, you know, I had some other things, but of course, like always, one is over optimistic. Let me finish here and, you know, basically end by saying, you know, I think, you know, there's lots of opportunities and challenges that, you know, kind of big data and machine learning, you know, will bring to financial markets. But I feel as academics, as researchers, I also think it will bring a lot of exciting research opportunities and ways to engage with regulators, with financial service industry about these new tools.